You may see certain structures, certain investment structures in a term sheet as well as in your definitive agreements. It just makes sense for founders, for finance professionals to understand what is the investor really communicating to me, what is the structure they're looking to invest in, and what does the structure mean for me as a company. Most sort of traditional finance professionals are familiar with investments into equity, but the entire investing industry will invest in preference shares, and the reason for this is to enforce their rights. So most investors will insist on a liquidation preference right. They will say that in case you're selling the company, we're liquidating the company, I have the right to take out my capital in preference to the founders taking out their capital, which means I need to invest in a preferential instrument. In this case, in most cases, it will be a convertible preference share. Like I said, it's a compulsory convertible preference share, which is the most standard instrument in most cases. But if you're a domestic investor, you have the option of having a optionally convertible or a partially redeemable sort of structure as well, which is like quasi-debt and quasi-equity. We are seeing a lot of differential voting rights instruments, which are prevalent in the market. This is a little bit niche, but it's gaining sort of favor. And it became, well reported when Ola used differential voting rights as a structure for the founder to retain voting control over the company, while economic interest, got diluted to investors. So this could be a means by which founders, continue to sort of control the company, despite having their stake fall to 26% or below 25, or even in the single digits. Convertible notes again are a structure which you might see more relevant during bridge rounds. So you may be between a Series A and a Series B sort of fundraise. You may be running out of capital. You go to your existing investors and tell them, please bridge me from Series A to Series B. So the investors may choose to invest in a convertible note and tell the company that, okay, we are giving you capital. We are not setting the valuation for it today. We will take the valuation to be a discount to your Series B round of funding, provided you commit to completing your Series B within a certain time frame. If you're not able to close your Series B in that time frame, then we reserve the right to even take out the capital if required, or convert at a much lower valuation, typically the last round valuation. A variant of a convertible note is what is known as a SAFE, simple agreement for future equity, which was popularized by Y-combinator. So here, the intent of the investor is not to spend time negotiating and agreeing on valuations, but to say that, okay, I like you as a company, let's not disagree on valuations. Take my money, give me a certain instrument, I won't set the valuation, I won't set the stake for it today. And you can give me a discount to the next round's valuation and convert me at that point of time. So a SAFE agreement in India will operate in the form of a CCPS for the most part, but without a valuation being set. Now, what happens if your next round of funding doesn't happen within a certain specified time frame? Then there has to be some sort of a floor valuation, which will be a low valuation where the investor ends up getting a higher stake. And there could be warrant as structures as well, which you'll find on cap tables and on investor term sheets, typically used as a means for founders to enhance their stake in the company. So it can be a performance-based warrant to say, okay, if I perform a certain and achieve certain levels of revenue or EBITDA going forward, then I may have warrants which will trigger, which may convert into equity and give the founders additional stake in the company while diluting other investors.